welcome to our first monthly investor call. I'm Mike, Chief Investing and Trading Officer at Walnut Investment Capital Group. Once every month, probably towards the end of the month, we do an investor call in which I talk about what investors should be looking ahead to, what our current view of the market is like. We will also go over stocks in our portfolio, why we're still holding them, what we can do to them, and then we take a couple questions from people who've emailed us. First, let's talk about the biggest market event that took place midweek of this week, which was the Federal Reserve's FOMC meeting. If you've just joined, you can read and hear more about our reporting of that event in the Market Analysis tab of our website. Essentially, we have the Federal Reserve came out and said, at the moment, inflation is transitory, bond purchase is to continue, but they're beginning to discuss tapering, and we may see interest rate hikes in 2022. How did the market react? Well, you have cyclical stocks, reflation trades, or stocks that would benefit from inflation took a big dive. You name it. You have Caterpillar, an industrial stock, down 5% this week, 9% last week actually. You have Freeport-McMoRan, a commodity stock, down 15% this week. Bank of America, down 7%. Meanwhile, growth stocks, which were hated for the first half of this year, caught some bid and are moving higher. If you take a look at AMD, up 4% this week. Nvidia is up 4.5%. Amazon is up 4%. Twilio is a very aggressive high beta growth stock, up 10%. NIO is up 3% this week, while GM is down 3%, even though these are both car manufacturers. Why is that? The cyclical stocks, the reflation trades, they all benefited from inflation. Now we see that the Federal Reserve is becoming more hawkish through indications of tapering of bond purchase, raising interest rates. The yield curve is flattening out. Commodity prices are plummeting, which all are bad signs for the reflation trades. When the Federal Reserve starts thinking about tapping the brake on the economy, again, through tapering of bond purchase and eventually to raise interest rates, this means growth in the economy will slow. As we typically see when this happens, investors sell economically sensitive stocks like the industrials, materials, and the financials, and they buy the secular tech plays because the latter are the ones that will continue to grow in a slower economy. Let me bring up a diagram of a theoretical economic cycle, and let's talk about where we are in an economic cycle and how to position our portfolio accordingly. So you can take a look at the bottom right of the screen. So when COVID hits, the world, we went to a recession, and that's the trough here. Then we started getting the virus under control, especially with the COVID vaccines, and we went up into the expansion phase here, which I'm trying to circle with my pointer. You see that with the recovery of economic activities, you hear about commodity prices going up like crazy. For the past 2 months, you hear talking heads on CNBC saying that commodity prices are peaking, and in fact we do see them peak. So what this leads to is that the market thinks we're at peak of the economic expansion or peak of this move in the cycle, and we've reached peak of economic growth. In other words, we won't get as good economic data as we've been getting. When this is the case, investors would want to sell cyclical stocks or stocks of companies that do well when we're at the rising phase of the expansion curve, stocks that would do well here, and buy secular stocks or stocks of companies that do well regardless of where we are in an economic cycle. So that's what the broad market thinks, that we are at peak. So that's what market thinks we're like here. And indeed, that's what we've seen for the past week in the stock market. As I just discussed before, you have industrials down while tech was up. However, I don't think we've peaked. And so here are a couple of reasons, and I'm going to present them to you. First, the pace of recovery is uneven throughout the world. Even in the United States, we've only reached 45% vaccination status, meaning half of the population here remains to be vaccinated, meaning those 55% are susceptible to getting the virus. This allows the virus to still incubate in the population, and given enough time, they will mutate and produce different variants that may, unfortunately, make the vaccines ineffective. We hear stories about the Chinese vaccine only 50 to 70% effective, and there are more concerns with the newer variants of the virus. You hear about shutdowns in China, and in part that's what causing some declines in the stock price of Wynn Resorts. So if that's the case, then we haven't reached peak economic growth. In America, where the path to recovery is still relatively uncertain. We need to get more people vaccinated, but we're hitting kind of the slow, we indeed are hitting the peak in vaccination, as the majority of Americans now don't want to be vaccinated, and those are the ones susceptible to getting the virus, and those are hosts for the virus to mutate. So I don't think the recovery from COVID is very certain ahead of time. We may unfortunately see shutdowns again in the future. Probably, it's not unreasonable to think that that would happen in the United States. And certainly you have the rest of the world. There are a lot of countries, the majority of countries around the world, they have not reached 10% vaccination status yet. So that's reason number one, is that the recovery is uneven throughout the world. Second, the expansion phase of the economy. In economic cycles, textbooks usually have them as 5 years is when the expansion phase, is how long that is. In the previous cycle, the economy had been in the expansion phase for actually about 12 years. The last trough was in June of 2009, right after the Great Recession. We reached another trough last year during the pandemic, so that marks about 12 years. We're now a year into a recovery, into the expansion, and there are still breaks. How many months have America really opened fully? Couple months. You have cruises that are not sailing yet. You have international travel that is not happening. So I think we're far from reaching a peak. Another point that I have, and I want to remind everyone, is the infrastructure bill that is to come from the Biden administration. At the beginning of this year, infrastructure bill was a big push for cyclical and industrial stocks, as these would mean more government spending, more contracts, more projects. Politics got in the way as usual, and talks on this bill kind of waned off. Until now, we still have no clear direction about this bill, and I think that's why market sort of forgets that this exists. In other words, the infrastructure bill is not affecting the market as much, or I wouldn't say affecting, but I would say it's not driving the market as much, because an infrastructure bill is good for the market. But as somebody who has been following politics for more than 4 years, the Democrats will get this done, if not this year, then early next year. They have to. This was one of their biggest promise in the 2020 election, and the 2022 midterm election is coming up. So they have to deliver that promise. During the 2016 election, you have the Republicans who promised a tax bill, and they got elected to the White House, the Senate, and the House. They eventually delivered that promise as they passed a tax bill at the end of 2017, which is about a year into Trump's presidency. Even with that, they failed part of the 2018 midterm election as they lost the House to the Democrats. This time, I think Democrats and the Biden administration, They know better. They know that in order to survive the midterm election, which again is at the end or November of 2022, they have to pass this infrastructure bill because it is so popular. They have from now until probably early next year to pass this, and I'm sure they will. And once they do, this will be another push to expand, to fuel this expansion phase of the economic cycle. And just a last but not least point, I think it's also important to remember that these phases, the economic, the phases here of an economic cycle aren't exactly going in a straight line. We can have mini cycles on the way up and mini cycles on the way down on these curves. We are in this expansion phase, and what can happen is we can go up a little, it slows, and then go down a little, and then back up a little more. That would still mean we're in an overall uptrend. So, for example, we may be, at the beginning of the year with the Recovery Act that the Biden administration passed that gave a lot of money to the American people, boost the consumer base. That boosted the economy, and then we haven't gotten that bill since. And unemployment benefit is running out. So we may hit some slowing there, but once we get another bill, the infrastructure bill, that will boost the economy. So that will be, kind of what I'm trying to say is it's not a straight line that we need to follow. We can still go up, we still go down. Those are mini cycles that we follow in this overall uptrend here. So those are reasons why I don't think we've reached peak economic growth, and that's why we're still keeping banks, commodities, oil, and recovery stocks in our portfolio. We have a barbell approach, meaning we keep both cyclical and secular stocks. With cyclicals coming down, secular has been going up. Historically, we're up against a seasonally weak time of trading, in which 22 out of 22 previous years, we see declines in this period of time, according to the legendary technical analyst Larry Williams, which was featured on Off the Chart segment on CNBC, and I covered last week. I think after next week, the cyclicals will get some bid again, after the market thinks about how ridiculous the notion of peak economic growth is. That's why we're not selling cyclicals during this downtime. But on the other hand, we think indeed secular growth will break out. Most of these stocks have been underperforming cyclicals for the first half of the year. So I don't think we will have the dynamic that we saw previously, that when cyclicals go up, secular growths go down. I don't think for the latter part of the year we will see that. So what do we do going forward? I'm going to go over stocks in our portfolio one by one. I'll start with the 1 ratings, go over stocks alphabetically, then the 2s. Again, 1s are stocks which we want you to buy right here, right now. 2s are stocks that you can buy on weakness. I'm not going to read to you what we have written about these companies, which are a lot, but I'm going to provide you the personal touch that I have for these stocks. So if you just allow me a moment, I will pull that up. So I want you to look into this list here, and it's also available on our website. On the left-hand side here, I highlighted the 1s that we have, so stocks that we want you to buy right here, right now. And I'll be discussing them in alphabetical order. Let's start with Apple. Apple is finally looking like it's going to get that breakout of the nothingness it has been in since August of last year. Check out the swing trade tab to see that pattern. What I find most fascinating about Apple now is that I can see the watch being the crucial product, one that is equivalent of an engine light that goes when your health is ticking badly. Maybe we'll at least treat our bodies better than our cars. Let me read to you a piece about Apple, which was posted in the Wall Street Journal. Speaking to Apple's well-known desire to be a larger player in the medical space, the Wall Street Journal reported that Apple has envisioned an audacious plan for healthcare, offering its own primary care medical service with Apple-employed doctors at its own clinics, according to people familiar with the plan and documents. To test that and other bold healthcare ideas, it took over clinics that catered to its employees and built a team with scores of clinicians, engineers, product designers, and others. Well, that plan has yet to materialize as Apple has focused on hardware such as the Apple Watch. The report speaks to just how grand the company's vision is for the space, and we expect further innovation and more aggressive investments in the space in the years ahead. So when you tell me Apple is struggling to sell phones, give me a break. Apple is not just a phone company, it's subscription services, it's healthcare, it's virtual reality, and it's going to be electric vehicle in the future. Next up, Abbott Labs. Remember, we only bought this stock because it got dinged by the market after it guided down. We didn't get hurt in this. We bought them cheap, and now I'm trying to justify to you why this is truly a stock that is on sale. It was a rare disappointment from Abbott. They were late to the market with a do-it-yourself COVID test, but they were late because the US government delayed the launch. Now that we're out of the pandemic, finally, there are no needs for COVID tests. But from the start, Abbott is not about COVID tests. We're now solely focused on the diabetes franchise, which is a great one. We've gotten the COVID test uncertainty out of the picture with the stock down after it removed that front. If you have no idea what I'm talking about in terms of Abbott, you go read our analysis about Abbott in our website. Next up, Advanced Micro Devices, AMD. What can I say? I expect imminent international regulatory approval for its merger with Xilinx. And when that happens, I think the company will be re-rated upward because of the acquisition and the transformation. Xilinx gives the company a differential from Intel. I have to tell you, getting away from being in the orb of Intel is good. I applaud the move. In fact, I think AMD will crush Intel. Next up, Boeing. Boeing, unfortunately, is not going to have a good quarter. They did not get enough orders, but also with a new CFO, many fear a giant equity offering is coming. Remember Smith, the CFO, said that there wouldn't be. So that's a double whammy. If you don't it yet, I would wait for it to come down. I think maybe 235, 230, although it probably will get there in the next week. I said Boeing is not going to have a good quarter, but we don't own it for the quarter. We own it for the long run, which includes imminent recertification of the MAX 737 in China and more ordering of planes as airlines recover. Next up, Alibaba. Baba has been the biggest headache to us. While the US market, in terms of S&P 500, the Nasdaq, have risen to record highs this year, Baba has made new lows and new lows along the way. It is because the fear that China will crack down on the company, and I think that is the only reason why Baba has been down so much. It has been down so much that its valuation is so cheap compared to the tech companies in the US. We just have to own it. We don't think China will destroy the company because it's so big. I don't think China will have problems with companies, but rather problems with their executives, individuals like Jack Ma. And if that's the case, they'll target the individuals rather than the whole company. Next up, Ford and GM. Let's talk Ford and GM together because they have roughly the same story. Traditional combustion engine manufacturers with best-selling cars by a mile, now transforming those best-selling cars to better performing electric cars. but they are not being treated that way. The market still thinks they're old school. They're not. Ford is so tough. A couple days ago, Jim Farley pre-announced a better than expected quarter. Pre-announced it, and the stock is still down. Will you give me a break? It's caught up in this rotation that we're seeing where people want to own tech because they feel the economy might be slowing down, or that the willy-nilly inflation is off the table and they don't want anything cyclical. So suddenly Ford and GM are part of a group that they shouldn't be part of. Again, we want them to be, rated as electric vehicle companies because they will be. It's unfortunate to say, but I think Ford may pull back a little bit more. I would buy it right here, but buy some more if it comes down. Next up, Microsoft. What is there to say about this company? They're so innovative on every front. They're secular, they're safe, and they're tech. It remains inexpensive versus its historic growth rate and its consistency. Next up, we have PayPal. I have a lot to share about PayPal because we ourselves are just kind of trying to reason with ourselves about our newest decision to buy PayPal. This is the premier way to play the secular growing digital commerce economy. We started buying this when it was about 18% off its February highs, or all-time highs, in fact. The reason why the stock had fallen so much had nothing to do with the company's fundamentals. Instead, PayPal's correction was mostly driven by the rotation out of high growth due to higher rates. Remember that whole enchilada at the beginning of this year. And we're seeing the opposite of that. Yep. So let's take a look at the company's first quarter results because they were just absolutely phenomenal. PayPal reported a 50% increase in total payment volumes, resulting in a 31% increase in revenues. That increased a little bit over $6 billion, and adjusted earnings per share very strong as well, nearly doubling year over year to 1.22. Free cash flow performance here is absolutely incredible, 1.54 billion. This is PayPal, just an incredible growth that it can deliver for you. What's really interesting about PayPal here is how much COVID-19 helped their business. They're still seeing some great things afterwards, remember? Pre-COVID, PayPal usually added about 35 million net new active accounts for the year. 2020 was a new normal for them. PayPal added 73 million net new active accounts, so about double, because the COVID dynamics and move away from cash and the push to e-commerce. I think COVID was a push to that new habit for customers in terms of digital payments. Now for this year, PayPal expects to add just 52 to 55, again higher than what was pre-COVID, but for longer term they're expecting a total of 750 million by 2025, which is very ambitious. So clearly the fundamentals of the business are incredible. The gains made during COVID are here to stay. But what has us really excited are management's plans to create this financial super app that CEO Dan Schulman outlined during the company's 2021 Investor Day in February. PayPal believes people just have simply way too many apps on their smartphones right now, and many of those apps are just rarely used. So their solution to this problem is to create a one-stop shop that turns all of these separate apps into a connected ecosystem. It's going to be payments, shopping, financial services, all in one app. Meanwhile, the company is updating its PayPal and Venmo apps first time in years, including new functionalities like direct deposits, crypto investing, which a big thing, financial management tools, shopping, and much more. And in addition to this super app, PayPal is seeing strong uptake, in initiatives such as Buy Now, Pay Later, which allows shoppers to pay for goods in 4 separate interest-free payments over a 2-month period without impacting their credit score. So again, that's essentially kind of like lending money, but that pushes customers to spend more. Now, this is a business very similar to the public company Affirm, and Affirm always get all the attention, but I think PayPal is really going to be the leader in this space because they have that two-sided network of tech and lending. And then just to touch on cryptocurrency availability in the apps, well, we think it's a strong move to include this type of capability into the PayPal and Venmo ecosystem, as it ensures that the company's offerings are up to date with the latest trends in the financial system. It also provides an additional touch point, because one thing that we know about PayPal and their crypto users is that they're very engaged. They like to use these apps every single day. So, PayPal, I just presented the case to you. We, like I said, we're still trying to kind of not second guess, but judge our decision. We currently have PayPal as just 2 or 3% of our portfolio. We're trying to see if it's worth it to raise that to maybe about 4 to 5%. We like PayPal. So that's PayPal for you. Next up is UPS. So UPS got dinged after an analyst meeting where CEO talked about a realistic goal of profit over just willy-nilly growth. People hated that. I mean, I just wish they didn't have that analyst meeting. So yeah, as long as they didn't talk, everything was good. Anyway, I think that people wanted both growth and profitability, and CEO Carol Tomé wouldn't give it to them. UPS is known for being realistic about their guidance. So the company's stock is getting clobbered. Nothing has changed about the fundamentals of this company, and it is only getting better. And then next up, we have Wynn. The recovery in Vegas is getting very strong and will be even stronger as more people get vaccinated as we go into the summer. And then in the fall, you have NFL football. That will be a monster. So just give me a second before we get to the twos of our portfolio. Now we have on the right hand side here, stocks I highlighted yellows are the twos of our portfolio. Let's talk first Bank of America and Citigroup. We'll talk about them together. They're both banks because this week was the deciding moment for them, and also next week. I think at least for this quarter, we're going to have the banks out of favor, as rates, as seen with the long-term treasury yield, are trending down. But I've got to own them through CCAR, which is coming up, I think on Thursday, I believe, which is when the Federal Reserve stress tests the banks, and if the banks can pass, they will allow the banks to buy back shares. I think that will give us some leg up to line up some of the position in banks. Banks are tough this quarter, and we realize it. It was right after the FOMC meeting. We were lucky we lined up some of our position going into that meeting, but we certainly didn't expect them to be coming down this much. But there's still a two. We still want to own them. CRISPR. This stock is speculative. You've got to know that. The science, the technology is awesome and will be the future, but right now it is speculative. That's why we only own a very small position. You don't have to own it. Only do it if you like the science. I do. Next up, we have Diamondback Energy and Kinder Morgan. You have oil prices facing some pressure this week. I think we'll also into the next week as well. We took some profits in Diamondback last week, right before the FOMC decision, and we're happy with that decision. Oil is holding above the $70 level despite a strengthening dollar and broad sell-off in other commodities in the past week, as demand expectations into the summer driving months remains very bullish. That said, given where prices sit, we are keeping a close eye on OPEC, as the higher prices can start incentivizing US producers to increase production and may impact OPEC's efforts to curb supply. In explanation, higher prices are good for OPEC members, but if they got too high, the risk of increased US production could diminish OPEC's efforts to control supply. Next up, Moderna. This stock is wonderful, but it is too high. We don't want you to buy anything right now. If you think that the COVID vaccine thesis is over, think again. You're not done with getting the COVID vaccine. It's going to be every year. We're also not done with variants. And they don't just have COVID vaccines. The mRNA technology is incredible. It's proven now. And we're so excited for the years ahead of what they'll be able to deliver. We got in the low 180s, and we'll keep our cost basis that way. Freeport, McMoRan, and Nucor, let's talk about them together because they're both commodity plays. Commodities got clobbered this past week. Nucor is expecting to achieve earnings in the range of $460 to $470 dollars per diluted share, the highest quarterly earnings in the company's history, and well above expectations of $436 per share. We will buy Nucor at whole round numbers, 90s or even 80s. The more it comes down, the more attractive. If you think the steel cycle is over, you have to think again. This is going to be a multi-year run. Freeport McMoRan is also good, but not as good as Nucor. Freeport is in copper, which is more of a play towards electric vehicle. Copper prices may be topping here, but we're just getting started with the demand curve. Remember, electric vehicles use more than twice the amount of copper than original combustion engine vehicles. Next up, we have NIO and Tesla, our biggest holdings. We weren't able to buy at the bottom because we were overweight from the beginning. Our cost basis for these stocks were too high, especially NIO, but we think 30s will be the lowest that NIO will go. I think it's consolidation and uphill from here, given the chip shortage is considered to be over. We still like Ford and GM better, but we think you should buy, which we think that you should buy Ford and GM for your EV plays. We know people have problems with NIO and Tesla in terms of valuations, and we respect that. But NIO and Tesla are growth plays. We own them for what they can do in the future. We have both the NIO Tesla pair, which is growth, and the Ford GM pair, which is value. So we feel pretty comfortable. Next up, and actually last, we have Shift Auto. We own this because it's cheap growth, but we're debating ourselves whether cheap growth means low quality growth. We just downgraded this to a 2. We don't think you should buy at current prices, but buy if it gets down to the low 7s or even the 6. We own this platform primarily because of the chip shortage and the scarcity of new cars earlier this year. And disappointingly, the stock never reacted to that. Now production capacity from, let's say, GM or Ford have picked up, and the supply problem for new cars will resolve itself. We don't really see any reason to be aggressive with this stock. So again, we just downgraded this to a 2. We'll at least wait for them kind of to report what their latest quarter was like and how the company is doing financially. And if the outlook is lame and if the market continues to ignore the stock, then we'll have to exit this name. So that's a Shift Auto for you. And in fact, that's all stocks in our portfolio, ordered by ratings and alphabetical orders. And so for the last part of this month's investor call, we're going to select 3 questions from investors who have emailed me, and then I will answer them here. So just give me a couple seconds. All right, so we have the first question. What are your thoughts on Walmart going into year's end? I think Walmart is tough. People say, um, you hear about news reporting that in the coming months or years, Amazon will overtake Walmart as the biggest, a grocery superstore. Even that, the short answer is yes. I think you can own Walmart. Um, right now, it is the biggest supermarket, biggest company. Um, it is trying to get into e-commerce. It is competing with Amazon's, grocery side of things. And like I've said, people project that in the years ahead, Amazon will surpass Walmart. We had this trade back in, I think it was Labor's Day, or maybe even earlier than that. End of March, beginning of April. We have the Walmart and the Costco trade. Costco clearly break out, and Walmart was supposed to follow, but it didn't. I think it was because of some reports that Walmart was seeing slower growth in their Walmart Plus subscriptions. So that news, didn't allow Walmart to go up together with Costco. They kind of, in the same group. And then later on, Walmart came out with their numbers, and the numbers were fine, but the people never cared about Walmart. So I think maybe own Walmart, don't trade it. I think you will. I don't see any catalyst going into year's end with Walmart. It is defensive stock. It is something that we call, a secular growth. Walmart will always do well. Doesn't really care about the economic cycle. People, need to go grocery shopping regardless. They are able to pass inflation costs onto customers. So I think own Walmart, don't trade it, is what my answer to your question is. Next question. How should I position my portfolio for the rest of 2021? Heavy growth or heavy value? I think it's going to be heavy growth. If you have to ask me, maybe 60%, 65% growth, and then the remaining to be value. Even though I told you that I don't think cyclicals are done, because the expansion phase of the economic cycle, I don't think is over yet. I don't think we're at peak growth for the economy. I don't think we've reached peak of the economy. Market is thinking that way. If the market is crazy, you have to play with the market. You have to see what the market is doing. You have to see what big money is doing. Remember, at the beginning of the year, everybody against the Fed, the Fed said this inflation is transitory. This inflation is transitory. Everybody freaked out because of the big hot inflation numbers. So what did they do? They sold tech. You saw NEO got clobbered. You saw, growth stocks we talked about, like Microsoft, Apple, AMD, Nvidia. All of them got clobbered because people were afraid of this inflation. They didn't trust the Fed. Even though eventually we're seeing right now, today, that the Fed, may be right, that this inflation was transitory. And the market is now, getting away from those anti-inflation trades and siding with the Fed right now. So the market is crazy. We want you to keep a barbell approach. We want you to have both. as long as you have high quality names, companies that will be able to deliver good earnings, you have good reasons to own them. Um, I think you can. I think you can own. Yeah. So I would say again, um, don't maybe heavy growth, but also don't have it too much in your mind that, oh, I have to own 65%, I have to own 70% growth. As long as you think your companies will be able to deliver upbeat earnings next year, that would be good. For example, Boeing. um, I can't really tell you whether Boeing is growth or value. I know, and what I can tell you, the reason why I own Boeing right now is because they will get big orders next year. Their balance sheet will improve next year. They will get recertification from China next year. So their earnings will be good next year. That's why we're owning Boeing. So that's some of the reason. If you think about AMD, that's secular growth. It doesn't care about the economic cycle. Yeah. So again, not so much growth versus value, but good companies and able to deliver good earnings into the future. And then just this last question, what are your thoughts on Amazon? The stock has not moved much in a year. Um, Amazon Day is on Monday, the 21st. Hopefully it will break out. If you own it, that's great. I think you should hold it. If you don't, maybe get in early Monday morning. I don't know, or wait, because again we're up against that seasonally weak time in the S&P 500. I think Amazon is safe, and if this peak economic growth continues to play out, there's no stock better than Amazon. They have pretty much everything. They have consumers, they have the AWS system, they have online shopping, tech, and also healthcare. So Amazon is like, as a stock, but you're pretty much owning an index there because it contains everything, a lot of things. So I would say own Amazon, don't trade it. It is a great company. Technically, it has been awful for the past year, but maybe that's the basis for it to break out next week. I don't know. So, yeah, if you own Amazon, that's good. If you really like it, find yourself some good reasons to own it. That's what I would say. With that, I would like to thank you for sticking here today, watching the video. We hope you have enjoyed it. We hope everything made sense. I will post together with this video posting the transcript, so you can, if you care about what I said about Boeing or Apple, for example, you can just control find Boeing or Apple in the transcript and see that way. Again, we do this once a month, and we'll see you back for this call next month. So thank you very much for watching, and have a good week ahead.